Okay, good afternoon, everyone. I think we've got most people admitted to the session now, so we'll get started. Thank you for attending this webinar where we'll discuss the audit implications on the removal of special purpose financial statements for certain for-profit private sector entities and the effects of the introduction of the simplified disclosure standard. So this is the third webinar in the series, so welcome back to those of you that have joined us previously and welcome to those of you joining us for the first time. My name is Kim Carney. I'm on the staff of the AASB and I'm pleased to be joined today by Carmen Ridley and Anne Waters. So Carmen's a recently retired board member and she's working with AASB staff on certain projects, one of which is this series of webinars. And Anne is the Deputy Technical Director with the AUASB. Now, before we start, just a little bit of housekeeping. So as with all our presentations, any views we express today are our own and they may not necessarily be shared by the AASB or the AUASB. Also, if technology permits, we plan to include a recording of today's session on the AASB YouTube channel, and you'll also receive an email in the near future with a copy of the presentation slides as well. We plan to pause at various points during the presentation to allow you to ask questions. The best way to ask your questions is by typing them into the Q&A function, and we'll attempt to answer as many of them as possible. On computers, the Q&A function is in the taskbar, which should be at the bottom of your screen. And if you're joining us from a mobile, you should be able to click on the screen to get the option. As the intention of this particular webinar is to cover audit implications, we're expecting there may be some questions that relate to matters that are more accounting standard or accounting standard application. So the intention is that we'll park those and we'll come back to them at the end of the session if time permits. But certainly any questions that you have, the Q&A function is the best way to communicate with us. So by way of background, in early 2020, the AASB removed the ability for certain for-profit private sector entities to prepare special purpose financial statements. And at the same time, they introduced the simplified disclosure standard, a disclosure standard which replaces the existing reduced disclosure regime. During the first webinar, Carmen gave us a high-level overview of the changes, including outlining who is affected by the changes, what affected entities need to do, and Carmen also explained what happens if an entity can continue to prepare special purpose. During the second webinar, Carmen discussed the transitional relief available for those entities transitioning from RDR, those entities transitioning from special purpose. And as I mentioned earlier, a recording of both of these webinars is available on the AASB YouTube channel if you missed them. Now in this session today, Carmen's going to give us a really quick recap on what we've covered previously, and then Carmen's going to pass over to Anne, who will take us through the audit implications for entities transitioning from both special purpose and RDR to the simplified disclosure standard. So at this point, Carmen, I'll pass over to you.
Excellent, thank you, Kim. So welcome everybody. As I say, whilst the intention of this session is audit focused, we thought it was a little bit mean if we just launched straight into the auditing without giving you a very quick recap on what the standards require from an accounting perspective. So I'm going to give you a very quick whirlwind tour and a reminder of what we've talked about already in the previous two webinars. So we do have AASB 2020-2, which is the standard that removes the ability of certain for-profit private sector entities, and just to re-emphasize, for-profit private sector entities, to be able to continue to do special purpose accounts. So if you meet either of these two criteria that we've got on the slide, you will no longer be able to prepare special purpose financials from 1st of July 2021. So for a June year end, that is 30 June 22. First requirement is that you are governed by some legislation, and that legislation requires you to prepare financial statements in accordance with accounting standards or Australian accounting standards. Second requirement is where you have got a constituting or other document. So for example, a trust deed, a constitution, a bank agreement that requires you to prepare financial statements in accordance with Australian accounting standards. And we talked about grandfathering in the previous sessions. So depending on the date that document was created or amended, you may still have an ability to do special purpose with some extra disclosures. Or if that document was created or amended after the 1st of July 21, you will be doing general purpose financial statements. So what will general purpose financial statements look like under this new regime? Kim alluded to the fact that there's a new tier that's been issued, AASB 1060, simplified disclosure. So we will still have two tiers of general purpose. Tier 1 hasn't changed. It's the full IFRS financial statements. Tier 2 used to be our reduced disclosure framework, or reduced disclosure requirement. That's now gone. So any entity, regardless of the sector that you are in, who is currently doing RDR, will be required to move to probably the simplified disclosure. You could opt to go up to tier 1, but probably we'd see people moving to tier 2. The numbers will not change. If you're currently doing RDR, the numbers are identical. So our tier 2 will now be all recognition and measurement from the relevant standard. So if you want to know how you recognise and measure property, plant and equipment, you go to AASB 116. As soon as you get to the section that's called presentation or disclosure, you jump out of that standard and you jump into 1060. So 1060 is a standalone standard that deals with all presentation and disclosure requirements for tier 2 entities. So you're not having to look for shading anymore, a separate standalone standard. So there are two tiers of general purpose financial statements. If we look very briefly at the transition rules, so if I'm moving from one set of financials that I can no longer prepare to another. First one is the easy one. So either you are currently doing RDR, or you are doing special purpose financials and you are in full compliance with recognition, measurement, consolidation and equity accounting. So in both those scenarios, your numbers will not move. If you choose to early adopt, there is some relief from the couple of new disclosure requirements that are in 1060 that aren't in place for RDR. It's not a huge transition relief, but it is some relief available for you. If you adopt on the mandatory date, so 30 June 22 for June year end, there is no transition relief. So you will just put all those disclosures in. If we, however, are not currently complying with recognition, measurement, consolidation and equity accounting, that means our numbers will change. And therefore, we have some better relief, I guess, for you that will actually save you a bit more time. It depends whether you early adopt or do not early adopt. If you choose to early adopt, so for a June year end, that would be 30 June 21, you are not required to restate comparatives. So whatever your numbers looked like at 30 June 20, whether they were single entity, whether they didn't comply with any standard at all, you just put those in the financial statements. For 30 June 21, you make sure that those numbers are full compliance with recognition, measurement, consolidation and equity accounting. And your opening balance sheet is 1st of July 20. So that's the date that all adjustments go through retained earnings. If you choose not to early adopt, if you choose to adopt this at 30 June 22, that means that you retrospectively adopt this standard. So you restate your comparatives. So at the 1st of July 20, which again is your opening balance sheet date, you adjust all the numbers to comply with recognition, measurement, consolidation and equity accounting. Your 30 June 21 numbers are restated and your 30 June 22 are then general purpose tier 2. So that's my whirlwind reminder of the 3 hours or the 2 hours that we've spent in the previous webinars. At that point, I'm going to hand over to Anne, who's going to talk us through the audit implications of these accounting standards.
Thank you, Carmen, and thanks for attending, everyone. So what's the impact on my audit? So as Carmen said, it sort of depends. The accounting rules are a little bit complex, I suppose, around how people transition. The level of change from the prior period report to the first year upon transition, the level of change in those financial reports will be really what determines what's the impact on your audit. So for those entities that are going from RDR to SD, as Carmen said, there's just a few additional disclosures, so probably not a huge impact. For those that previously who were preparing special purpose financial statements, but they were in full compliance with R&M, consolidation and equity, and they're going to SD, they've got some additional disclosures as well, but the impact will be slightly bigger, but not as big as for those entities that previously prepared special purpose financial statements, but who weren't in compliance with R&M, consolidation and equity accounting. So depending on where the starting position and where you need to get to, that will really determine what's the impact on the audit. So the greater the change in the accounting and the more that they need to be disclosing, there will be the greater the impact on the audit. Next slide, thanks, Kim. So we have issued a bulletin about a month ago that went through the main things that auditors need to consider when they're auditing entities in the current period, especially those that are transitioning to general purpose who previously prepared special purpose. But a little bit of a caveat, I suppose, that each entity will be different. And as I said before, depending on where their starting position is, we couldn't, look at all possible scenarios. So we've highlighted the main areas that auditors need to be aware of when they're thinking about how to approach their audit on the transition. So the bulletin, I'll run through the main things today, but please look at the bulletin. It goes through a little bit more detail. Next slide, please. So the first thing is the financial reporting framework acceptable? So the financial reporting framework in Australia is now changing. So some entities that previously prepared special purpose financial statements can no longer do so. So auditors need to be across what those rules are. There's an existing requirement in the accounting, in the auditing standards to consider whether the financial reporting framework is acceptable. So you've got your 210 requirement, which is a precondition to the audit. You've got 800. So even for entities that will continue to prepare special purpose financial statements, auditors need to assess whether that is acceptable. And that talks about talking to management and those charged with governance about who are the users of the financial report and is it acceptable and appropriate for them to continue to prepare special purpose financial statements, even if the AASB 2020/2 allows them to. So there are some entities that can continue, but the auditors need to satisfy themselves and make sure that management and those charged with governance have satisfied themselves that that is still appropriate. So for those entities that are transitioning to general purpose, they have an option of tier 1 or tier 2. Auditors need to consider whether the financial reporting framework or the tier that they are choosing is appropriate and in the circumstances. They need to consider the transitional adjustments and whether they have applied 2020/2 appropriately. So is the financial report adequately described? So in the financial report, entities do need to describe the financial reporting framework that they're using. So auditors consider that when they're when they're reviewing the financial report and determining whether all the requirements around the financial reporting framework acceptability have been complied with. So 700 includes a requirement that the auditor checks that the financial report adequately describes the financial reporting framework and the significant accounting policies. Next slide, thanks, Kim. So comparative information. So as Carmen said, some entities, if they early adopt, will not need to restate their comparative information. Others will need to restate. AASB 710 includes requirements that auditors need to comply with when looking at comparative or corresponding, remember that it uses a slightly different term, information in the financial report. So auditors look at AASB 10, they consider what the rules are in terms of whether entities need to restate comparatives or not. If they don't need to restate, you agree the comparative information to the prior year financial report. If they do need to restate, you obtain audit evidence as required by AASB 710. So the work that the auditor does depends on whether the entity is restating their comparative information or not. Okay, so there are some transitional adjustments and disclosures. So when looking at the transitional adjustments and disclosures, you look at what the rules are in the accounting standards about when they calculate their adjustments and what they need to disclose. So remember, when you're forming an opinion on the financial report as a whole, you're considering all that disclosed information, and you're assessing whether the financial report as a whole is free from material misstatement. So those required transitional adjustments and disclosures are considered when forming an opinion on the financial report as a whole. Now, the amount of work that you need to do on those is dependent upon the materiality of those adjustments. So as we said before, some entities will have a relatively small number of adjustments. Other entities may have a lot of adjustments depending on whether they were in compliance or not and what standards they were complying with. So even if you're not restating your comparative, entities still need to prepare an opening balance sheet. So they need to determine the adjustments to opening retained earnings on transition. Auditors need audit evidence, and they need to perform audit procedures over those adjustments. So that information is disclosed in the financial report, and the auditor performs audit procedures. So ASA 510, so even though ASA 510 is specifically for initial audit engagements, it does include requirements around assessing whether the opening balances are materially correct and the impact that that will have on the current year. So auditors should refer to ASA 710. Now, one of the transitional relief, some of the transitional relief that the Accounting Standards Board have allowed, there's no specific requirement to distinguish the adjustments as a change in accounting policy or a prior period error in the financial statements. So that's a specific transitional relief that was given to encourage early adoption, I suppose, and to just to encourage, hey, let's get everyone on general purpose compliance with R&M and almost make it as easy as possible, I suppose. But there are some other responsibilities that auditors have in relation to prior period errors. So you just need to consider, once again, depending on the materiality of what some of those adjustments are, whether you think some of those adjustments are a change in accounting policy or whether they are a prior period error, even though they may not be disclosed as such. So prior period errors. So ASA 560 has some relevant requirements when an error is identified after the financial report is issued. So this may not be relevant. The auditor uses their professional judgment. If they think there's a prior period error based on materiality, they consider whether they think there is an issue with the previous audit report being out there and being relied upon. Depends on timing. There's some guidance in ASA 560. So that's just a reminder to look at that. Corporations Act. So Section 311 notification requirements still exist. So look at RG 34. There is no change there. So so auditors have an existing obligation to notify ASIC of any significant contraventions of the Corporations Act. That requirement still exists. RG 34 provides all the information that you need, but just be aware, as is detailed in RG 34, breach of accounting standards is considered a significant contravention. So you need to think about whether there is a prior period error, which is a breach of accounting standards. Fair presentation. So this is just a little reminder. We don't think that this is something that will be common at all. But at the end of the day, so financial reporting, compliance with the financial reporting framework, which is the accounting standards that the AASB have issued, in nearly all circumstances achieves fair presentation. But there may be some scenarios which we don't think will be common, but where the prior period error is material and the auditor has some concerns that it will impact the decision maker of users. And then the auditor considers whether additional disclosures are required to achieve fair presentation. The accounting standards are minimal requirements. Auditors you could always think about, and preparers should be thinking about whether there should be some additional disclosures to further explain some transactions. So what is an accounting policy versus an error? So we've detailed this in our bulletin. So generally, if an error is when there has been something identified that wasn't in compliance with the previous stated basis of preparation. So, for example, if the previous financial report, special purpose financial report, stated compliance with R&M, but upon preparing the current year report and determining what those opening adjustments were, it was identified that there were some adjustments to achieve compliance with R&M. They would be considered an error because the previous financial report stated compliance, but however, that wasn't correct. So if they stated compliance with certain accounting standards, but later identified that they weren't in compliance, any adjustment to achieve compliance with those stated accounting standards would be considered an error. Corporation Act entities, adjustments to comply with AASB 101, 107, 108, 1048 and 1054. I think that's based on RG 85, I think, or 85, 84 maybe, which is the ASIC's reg guide. Any other adjustments are a change in accounting policy. So if the previous financial report stated compliance with R&M or specific accounting standards, and then it was found that that wasn't correct, that would be considered an error. Any other changes to achieve in preparation in accordance with all the R&M and the accounting standards would be a change in accounting policy. We don't think this will be overly common, but we don't know, and we just wanted to highlight this.
Excuse me, Anne, if I can just interrupt. We've just got a question come through that's quite relevant to what we've just been discussing.
Yep.
So the question is just around if a material error is discovered upon transition to simplified disclosures, would that need to be assessed from an audit perspective and reported as a breach?
Yep.
You know, a departure from accounting standards.
Yes. So I suppose here I've sort of focused on special purpose financial reports, but yeah, if there was, so I suppose the second point would be relevant there, I think, Kim, that they've stated compliance with certain accounting standards, or sorry, they were doing RDR, so they were in compliance with R&M, and then that was found that they're not. So that would be an error.
Perfect. Thanks, Anne.
Okay, next slide, thanks. So other things to consider. So does the financial report adequately describe the financial reporting framework and the impact of the change? So as I said, for some entities, this last year's prior report, financial statements, is going to look considerably different to this year's financial statements, depending on the level of adjustments, the level, the previous, or their starting point. So it's important that you step back and say, does the financial report adequately describe why the prior period looks so different to this year, and what is the impact of the change of going from a special purpose to a general purpose? So the accounting standard has some rules around what needs to be disclosed. But I think it's important that ought to step back and go, okay, do we think that that's adequate? So this is just a reminder to the engagement letter. I think it's AASB 210, includes a requirement to obtain management's acknowledgement of their responsibilities in relation to preparing a financial report. So I would suggest that means that you need to receive acknowledgement from management that they understand that they're moving from a special purpose to a general purpose. Okay, so the auditor's report. So when forming their opinion on the first report, financial report after they've gone through transition or in the current year, you're still stepping back and say, has the financial report as a whole been prepared in all material respects in accordance with the applicable financial reporting framework? So has the entity taken into account the new accounting standard and the new rules? Have they considered if they're complying, if they're preparing under Tier 1, is it complies with full IFRS if they're under Tier 2? are they in compliance with 1060? So the auditor considers all that when they're forming their opinion on the financial report as a whole. For those entities that are still preparing special purpose, so refer to ASA 800, there's still the required EOM on the basis of preparation. So that will still exist for entities that are still preparing special purpose financial reports. For entities that are transitioning from special purpose to general purpose, on the year of transition, is there a sufficient appropriate audit evidence over the comparative information and the adjustments? So the extent and the nature of the work that you'll need to do over that really depends on what they're disclosing and whether they are fully restating comparatives or not, as we've just been through. EOM, should there be an EOM in the auditor's report? I think it really depends. The AUASB did consider whether we would say that we would have a requirement for the first year of transition to general purpose that the auditors have an EOM. It was decided that no, we use it up to the judgment of auditors. For some entities, there won't be much impact, and so it wouldn't meet the definition of an EOM in 706. But for other entities, such as those that weren't in compliance with R&M, who may be consolidating entities for the first time, there may be it may meet the definition of EOM, and the auditor would refer through to the disclosures in the financial report where it's been disclosed what the impact of transition is. So look at 706 as auditors use their professional judgment in determining whether they want to put an EOM in their auditor's report. So next steps. So discuss with your client their responsibilities. So it's management's and those charged with governance, it's their responsibility to determine the appropriate financial reporting framework. So if they're previously preparing special purpose, can they continue to do so? When will they transition? And how will they transition? So if they're going to transition early, what transitional relief do they want to avail themselves of? Calculate opening position, any transactional adjustments and disclosures with appropriate supporting documentation to allow you to obtain the audit evidence that you need to obtain over that information. So consider any impact on your fees and timetable. So if you're going from a special purpose, general purpose, there may be, depending on the impact, there may be lots of scenarios where it will take more time, and you need to consider that in your fee estimates and your timetable. Okay, so we have run through, we've really focused obviously on the auditors, implications for the auditors. Obviously, the accounting implications are really important. So we've already ran 2 webinars which go through in quite a bit of detail about which entities are impacted and how to enact the transitional relief. AASB have released a key facts document, which is under their hot topics. And as I said, we have released a bulletin which provides more detail on the implications for auditors. So please refer to that bulletin. We're also happy to receive questions.
Thanks, Anne. We've got quite a few questions coming through. So there's some that are perhaps more relevant for you from an audit perspective, and then there's a few questions that are probably more relevant for Carmen. So the first question I was going to ask was whether we understood or were aware of ASIC's position, or what ASIC's position is on Section 311 reporting, if it's only, I guess, a breach of RG 85 in terms of recognition and measurement and special purpose. Anne, are you able to clarify it all, please?
That's a good question. I have had discussions with ASIC over this, and the response was nothing's changed. Refer RG 34. So I didn't specifically ask that question about whether they're only interested in breaches from RG 85 or whether they're interested in all breaches of accounting standards or any other breaches which auditors may become aware of. So yeah, so anyway, I might give that thought and happy to think about that further. Yep.
Thanks, Anne. Another question that we've got here, and possibly Carmen, feel free to jump in as well. So the question is around accounting standards, but it's got an audit flavour to it as well. So the question is, accounting standards say that a difference is not an error. So why do we need to assess an error for auditing standard purposes? So there's that sort of disconnect. So Anne, Carmen, would you be able to help, please?
Happy to go. The accounting standards don't say it's not an error. What the accounting standards say is that there is no need to distinguish for disclosures between errors and accounting policies. So hence that there isn't a disconnect, particularly in what the requirements are from an audit perspective or an accounting perspective. It's just to be very clear that the accounting is not saying it's not an error, it's that the relief is purely for disclosures.
Yep. And I suppose the other requirements, especially around section 311, they exist, and there's, you know, that hasn't been changed, and ASIC are not going to change that.
Thank you. Another question that's come through is in relation to whether or not an entity consolidated in a prior year. So in a situation where an entity hasn't previously consolidated, we've talked previously how we'll have you know, comparatives will be single entity potentially, the current year will be consolidated. And the question is around whether or not the non-consolidation in a prior period is an error. So it's possibly more a question for you, Carmen, but Anne, also happy for any audit input, please.
I might have to answer whether it's a qualified opinion and add to it, but it's not an error in the prior year. If they assess that they didn't need to consolidate, either because they use the requirements of RG 85 or whatever other reason, and if they've now decided that, or there's now a requirement to consolidate because of 2020-2, my view would be it wouldn't be an error. And hence, Anne, I'm jumping into the auditing standards and saying if it wasn't an error, I don't see why you would qualify.
Yeah, I'm the same. If they said that they had consolidated or they were compliant with that accounting standard, but they weren't, I would say it's an error. But if they were silent on that and they didn't, but now they need to, that's a change in accounting policy.
Thank you. And so in a situation where an entity's previously been preparing special purpose and they've elected not to comply with either some or all R&M requirements, we've got a question coming through about how this is a breach because they've determined as a special purpose entity they wouldn't need to comply with R&M. And I think there's no more information, but I think this question is coming back to the requirement in RG 85 around, you know, ASIC's expectations and things like that. And I'm not sure if that was something that was covered when you were talking with ASIC and whether you had any thoughts.
Yeah, it was. ASIC have reviewed our bulletin. They wanted that point in there that then in their view that is an error, that corporations entities were supposed to be complying with those standards, and if they weren't, in ASIC's view, that is an error. Okay, sorry, representative of ASIC's view.
Perfect, thank you. Okay, I'm just moving down the list. So if we've got an entity that elects to early adopt and therefore doesn't restate the comparatives, we've got a question here around disclosures in relation to errors in the prior year financial report. I think the question is getting at. So Anne, I know you touched on this a little bit and there's possibly more of an accounting element in terms of how the actual disclosure works under accounting standards. But from an audit perspective, would you be expecting anything different other than what you've already covered in terms of auditors' responsibilities to consider their obligations and things like that?
So they've identified an error in the prior period.
Yeah, but they're not restating comparatives. So obviously from an accounting perspective would adjust through opening retained earnings.
Yes.
But there's nothing else that we need to be aware of other than what we've previously discussed.
Yeah.
Perfect, thank you. Sorry, I'm just going down my list. Carmen, this is possibly more of a question for you. So this is the question coming through is where an entity is no longer able to prepare special purpose under 2020-2. And the question is whether they're still able to call them special purpose financial statements. There is a reference in there to them still potentially meeting the definition of a reporting entity in SAC 1. And then from an audit perspective, the next part of the question is whether the financial reporting framework can be described as being compliant with Australian accounting standards because the entity is preparing special purpose because they're outside the scope of 2020-2. So that was a long question, but Carmen, I'm not sure if you wanted to tackle the accounting part first and then maybe Anne can help us with the audit part.
Yep. So if an entity is still able to prepare special purpose financial statements, that means that they're not required to do general purpose. So the way that the accounting standards are written is very much about who has to do general purpose. From my perspective, and this is my personal view, I wouldn't use the term special purpose financial statements because what does it mean? Nobody knows what it actually means. So the most important thing is really to just say these are financial statements and to describe very clearly in the basis of preparation what you do. It could be cash accounting, it could be modified accruals, it could be we choose to comply with certain standards but not others. So that's the more important thing. I wouldn't get too caught up in the special purpose. There's nothing stopping you using it. It's just, as I say, my personal view is probably not to use that terminology, to really focus on that basis for preparation. Does the reporting entity concept still exist? Only for not-for-profit entities. All for-profit entities, for-profit private sector entities are outside of the scope of that because that's been replaced by 2020-2. So if you were a for-profit entity and you believed you were a reporting entity in SAC 1, you are probably captured by 2020-2. So hopefully that answers that question from an accounting side. And Anne, I'll flick to you for the financial reporting framework.
Yeah, I'm sitting here trying to quickly look at 800, ASA 800. So ASA 100 is for financial reports prepared in accordance with special purpose frameworks. So you can still prepare, if you don't have to prepare general purpose, you can still prepare a financial report in accordance with a special purpose framework. So ASA 800 will still exist. So I agree with what Carmen's saying. Let's maybe not call it special purpose financial statements. So I think that's sort of a lingo that's been picked up in Australia. There's still this other concept of in a financial report that's been prepared in accordance with a special purpose framework, and that is one that's special to this entity. The auditor then steps back and says, okay, are they happy that the entity doesn't need to prepare general purpose? So then management of those charged with governance can determine what special purpose framework they want to prepare the financial report under. And then there's specific requirements for the auditor to discuss with management how they've determined the appropriateness of that framework. And if they don't think the framework is appropriate, they need to think about the implication for the audit report, the materiality of anything that's not disclosed or accounted for that they think it should be based on the intended users. But have a look at 800.
Okay. Thanks, Anne. Got a couple more questions coming through, and we've still got some time left today. So if there's anyone else listening that has questions, please feel free to type them into the chat function. So this question is a situation where previously an entity was preparing special purpose and they were preparing single entity. So they weren't consolidating, but when they're required to transition to general purpose, they obviously need to then commence consolidation. So the question is that if they wanted to show comparatives as consolidated, so therefore by that I'm assuming they want to restate the comparatives, the question is whether it would be a qualification of the opening balance.
No, I think then the auditor would need to look at ASA 710, which talks about what the auditor needs to do about comparative information and needs to gather audit evidence around whether that comparative, so if the comparative information is restated, the auditor gathers audit evidence around the appropriateness of the restated comparative information. If you cannot gather sufficient appropriate audit evidence over the restated comparatives, you do step back and have to consider whether you qualify on the financial report as a whole. but that really depends on the materiality of the restatements.
Yeah, okay, thanks. And so I guess the key takeaway there is it depends. Like a lot of things, it will come down to judgment and I guess the availability of appropriate audit evidence to support the restated information. And if there's sufficient information, happy days. If there isn't, then it's probably another thing to step back and consider.
Yeah. I can just add something to that. If and again, I'm not an auditing standards person, but if somebody was doing this and was preparing the comparatives in the opening balance sheet, personally, I'd find it quite hard if they said there's not the evidence to do it, because they've just done it. It's not something that happened 10 years ago that it's hard to recreate that. So I think, and from an audit perspective, I wouldn't want to see qualifications on opening balances because people say they can't do it when the client's just done the consolidation.
Yeah, and I think, you know, that's part of the conversation with clients as early as possible around how they intend to transition and what information that the auditor needs. And yeah, and we've got to be careful using term. I don't think we can qualify an opening retained on opening balances. Auditors need to look at 710, they need to look at 510, and then you consider the comparative information in the financial report as a whole. But Carmen's point is right. Challenge your clients. They're coming up with these numbers. Where are they getting the information from?
Thank you. Carmen, this is probably a question for you. So this question's coming through that, and I'm interpreting, so please, to the person asking the question, if I've misinterpreted, please feel free to type another question in and correct me. But I think the situation is we've got an entity and its users change from year to year. They're also not a large proprietary company for ASIC purposes, so they're outside the scope of the Corps Act. They prepared special purpose. Then, you know, in 2 years or at a future point in time, they become large. So therefore, they're now within the scope of the Corps Act financial reporting requirements. They need to prepare general purpose. And the question is around, you know, their classification is obviously changed. What does this mean for them from a, I guess, first time adoption of accounting standards, first time preparation of GPFS perspective?
So I guess, I think I heard you say for comparatives, but I'll cover that as well as first time adoption. If the exemption for restatement of comparatives exists only if you early adopt 2020-2, if it's relevant for you. So if at some point in the future you become large, there is no ability to then say, okay, fantastic, we don't need to restate comparatives using that particular standard. So if you are becoming large, my understanding is that ASIC do require the current year and the prior year on the same basis. But happy if either Anne or Kim, if you know something different from that. If you have never used the Australian accounting standards before, then possibly AASB 1 is still an option for you. But if you keep switching between small and large, then you've obviously used the AASB 1 before and you can't go back through that. So hopefully that answered, hopefully Kim interpreted it right and I've answered it, the question that we think that you're asking.
Thanks, Carmen. And we've got a question coming through here. So the situation here is we've got an entity that's outside the scope of AASB 2020-2. So they're preparing special purpose financial statements. They're complying with R&M requirements, but they're not complying with all of the disclosure requirements. So they're special purpose. And I know we touched on this previously, but just confirming how the, I guess, basis of preparation is disclosed in the financial statements and the impact on the financial reporting framework. So can those financial statements be said to be prepared in compliance with Australian accounting standards, the basis of preparation, financial reporting framework? What would you think from an audit perspective you would be expecting to see?
Well, I would have thought if they're not complying with the disclosure requirements, I can't say they're in compliance with the Australian accounting standards. So if you're preparing a report under a special purpose framework, your basis of prep says what you're doing. So it's almost like you say, we are complying with these standards, or we're complying with all accounting standards except for it's clear. So the most important thing when you're preparing special purpose framework is that the basis of prep tells the user what you are complying with, so they understand. Does that answer?
Yeah, I think so.
I might add to that as well. If you say you are complying with Australian accounting standards, that means you are preparing general purpose financial statements. So there is no ifs or buts. If you use that terminology, it means general purpose. You can still say we're complying with only the recognition and measurement and prepare non-general purpose accounts or special purpose, if that's what the term we want to use. But reference to Australian compliance with Australian accounting standards means general purpose going forward.
Okay, thank you. I've got a question coming through. So this question's perhaps a little bit specific. So it's around whether an entity that's required to comply with the franchising code of conduct is required to prepare general purpose financial statements. I'll take that question, I guess, and Carmen, feel free to interject if you have a different view. But I think from an accounting standards perspective, we say what you need to do when someone else tells you what you need to do. So whether or not the franchising code of conduct requires the preparation of general purpose financial statements, or whether it requires compliance with Australian accounting standards, that will be the hook as to whether you need to prepare general purpose or whether you can continue as you have been previously.
And I will just add to that, that I'm assuming the franchising code of conduct is legislative that you have to comply with. So Kim mentioned Australian accounting standards. If it is a legislative requirement, even if it refers to just accounting standards, you are captured and do general purpose. I don't know the content of that franchising code of conduct, so I can't comment. But entities who are governed by any legislation will need to understand what those requirements are.
Thank you. Another question coming through, and apologies, and most of these are accounting standard related questions.
Good.
But another question, another question coming through. So this is just in relation to grandfathered entities, and it's whether they need to prepare general purpose. I'm going to guess that the use of grandfathered in this context is an ASIC grandfathered company. So Carmen, a question for you, please.
Yep, so I'll answer that under the same assumption. So we are assuming grandfathered being the Corporations Act grandfathering. That grandfathering requires entities to prepare financial statements as if you were lodging them. The relief is only from lodgement. The requirements under the accounting standards say if you are required to prepare financial statements. So grandfathered companies will be captured, will be doing general purpose financial statements under AASB 2020-2. Nice to be able to answer a question without depends.
Thanks, Carmen. So just another question, and this is, I guess, just clarifying the comment that I think it was you made earlier, Carmen. So if an entity is continuing to prepare special purpose, so they're outside the scope of 2020-2 and they're able to continue preparing special purpose, you mentioned that compliance with Australian accounting standards is taken to mean compliance with all elements of all Australian accounting standards. So it's just clarifying, they could say something like they're preparing in accordance with the requirements, with the recognition and measurement requirements of a particular standard, and that would be sufficient?
Yes, yeah. So as long as it was very clear. So effectively what we're looking for is if you are not doing general purpose and I pick up those financial statements and I read the basis of preparation, do I know how these numbers have been put together? And that's all I'm looking for. I'm looking for you to tell me, is it cash accounting? I'm looking for you to tell me we've done cash accounting, but we've chucked in some rental provisions and employee provisions, or I'm looking for you to say they actually do comply with all recognition and measurement requirements of the standards, assuming obviously you're not required to do general purpose. So it's just about telling me the story. If I pick them up, is it really clear that I know how the numbers have been put together?
Perfect, thank you. Just scrolling down my list now, and I think you covered this previously, but if I could just confirm. So if we've got an entity that is still preparing special purpose because for whatever reason, let's say they're outside the scope of 2020-2, etc. So from in the future, they're still preparing special purpose. Can I confirm whether the emphasis of matter will still be required?
Yes.
Yeah,
Yes, it will. 800 won't be changing. ASA 800 won't be changing. And the reason being, for what Carmen said before, like, you need to highlight to readers and users that refer them through to the basis of preparation, that it's important that they understand the basis of preparation.
Perfect, thank you. Sorry, just scrolling down the list. Just got a question here, and Carmen, this is possibly a question more for you, but it's just for those entities where the main change will now be a requirement to disclose related party transactions, for example. In terms of the specifics, I guess, of those disclosures, we've got a situation where, you know, it's not uncommon, entities are purchasing goods or services from multiple related parties. And the question is just around whether you're able to provide any more detail, I guess, on what the requirements of the accounting standards are in terms of those particular disclosures. So whether they need to, I guess, single out, you know, each individual related party that they transact with, whether they can aggregate, that sort of thing, please.
So I saw that question, and luckily I have AASB 1060 on my desk. So I managed to find the page before you asked the question. So what 1060 says is, it says that you are required to split. So this is assuming you're going to tier 2, which is what we'd expect. You are required to split the disclosures into a number of categories. The first is transactions with entities with control, joint control, or significant influence over the entity. The next is entities over which the entity has control, joint control, or significant influence, key management personnel of the entity or its parent, and other. So you can't completely aggregate it, but you don't completely have to disaggregate it. So that relevant paragraph is paragraph 199 of AASB 1060.
Thanks, Carmen. We've got one more question here, unless anybody's feverishly typing away in the background. So this question is an entity that's preparing financial statements for the first time. So they were previously not required. So they're going to apply AASB 1. And the question is just around the early adoption of AASB 1, exemption from, you know, not being required to show comparatives. I'm not 100% sure whether I've understood the question correctly. So if you understand, feel free to interject. But the question is around, you know, whether I guess they can apply the exemption in AASB 1, whether you know, the exemption only refers to the notes, balance sheet, income statement on the face, you know, relief, or is the relief perhaps not available? Do you have any thoughts on how that might work?
So I guess I'm looking at the question and don't completely understand it either, because if you are going to have to do financial statements, we'll assume general purpose financial statements for the first time this year, I don't know how previously you would have not had to do any set of financial statements last year, because if we look at the two reasons that are going to push you to general purpose, one is legislation requires you to, and the second one is you've got another document that required you to prepare some financial information. So I guess that's where I'm a bit confused. We've got a further comment, may have got relief because subsidiary of another entity. I would still challenge you on whether you have to do general purpose this year. So I would really make sure that you've looked at that criteria. If you haven't done, it's no longer a sub, thanks. Well, I like the interactive questioning. And so it's no longer a sub, so it has to do it. I'm not comfortable that there is no comparatives. I don't know, Kim, what your thoughts on that, because the only reason I would expect to see no comparatives is because you were a brand new entity. So even though you might not have been preparing financial statements as such, I imagine that as a subsidiary, you had to provide some sort of financial information to the parent to be able to be consolidated. So even if, you know, you put in whatever you prepared, a balance sheet or an income statement, and just make a comment that you didn't comply with any accounting standards last year, I think it would look more unusual if there was no comparative when a company did exist. We did talk in the first exposure draft of this standard, we were talking about whether we remove the requirement to put any comparatives in. And the feedback we got that it looks strange when an entity's been in existence. So if I keep coming back to that, and I think we need to have some information, because this is not a new entity. There would have been some reporting up to the parent. AASB 1 can be used because, as I say, you've got financial information. It's not that you don't have any financial information, you do have that. And AASB 1 applies to everything within the financial statements. So at the opening balance sheet date, assuming you're a junior end, 1st of July, you would put all of the adjustments through on that date.
Thanks, Carmen. So we haven't got any more questions coming through at this stage. So what I might do is I'll just ask Anne whether you've got any final thoughts or anything else that you would like to leave us with before we wrap up.
No, all good. Thanks, everyone. Thanks for your questions. And we know it's going to be challenging for some entities with a lot of changes. It's going to be challenging for auditors. Just encourage you to talk to your clients early about what your requirements are, and so that they understand their responsibilities, and hopefully it'll go smoothly.
Perfect. Thanks, Anne. So on that note, we've
Can I have an
reached the end
opportunity for final comment?
You can have an opportunity.
Thank you.
You go.
So my final comment would be, given that some of these questions that we're receiving, please go back and look at the first 2 webinars, because lots of those questions we have answered within there. And this, whilst it's been a really great understanding of the auditing impact, the intention was not to answer the accounting questions. So please know that there are those resources available to help you, where we go into much more detail about transition and the accounting standards.
Thanks, Carmen. So that brings us to the end of today's session. As we've mentioned a couple of times, you'll receive an email with a copy of the slides attached. Technology permitting, we're also hopeful of putting a recording of this particular session up on the YouTube channel. So if there's anything that you need to go back and listen to, the resource will be available. And as Carmen just mentioned, obviously, the recordings of the previous 2 webinars are also available on the website. So on that note, I would like to thank Anne and Carmen for their attendance, for answering questions, for providing all of their insights. And I will close the webinar and say thank you very much to all of you for attending as well. Thank you.